Right, it is 11 o'clock, so let's get things underway. Welcome, Chris. Good to see you.
Thank you, Ryan. Nice to be in the office.
Yeah, makes a change, hey?
Yeah.
Yeah. But reliable Wi-Fi where you live out in the country isn't something that comes normally, is it? So, good to see you. So welcome everybody on behalf of Inspire. Welcome to this budget update. Chris will be running us through his predictions of what may be coming in the future, as well as a little summary of what actually went on in the budget earlier in the week. And I suppose, in a way, we probably all would agree it's what we expected, more and actually quite a lot more of extended support in the very short term. A bit of a lull then before some measures kick in to recoup some of the taxes that need to be increased in the future to pay for all the support that's been given in the last 12 months and other aspects of the pandemic. It's fair to say that I think Chris and I and the team at Inspire were surprised with the extent and severity of some of the measures. There were some headline-grabbing measures that aren't all that they seem. Chris will run through some of those. And also there's some complete silence on areas where we expected announcements to be made. So it took us a little bit by surprise in some of the areas, although won't say anymore, won't take Chris's thunder. Format of today is Chris will be running through a short presentation for half hour or so. Chris, 20 minutes, half hour.
Something like that.
Which will just outline the key measures that were introduced, and as I say, some thoughts about the future. But we will then be running a Q&A session so that you can ask any specific questions of Chris and I'll be there to support Chris, that you may have concerning the budget, and we'll do our best to answer those questions. So as this is set up as a Zoom webinar, the best way for you to ask those questions is to use the Q&A function that you can find in the toolbar at the bottom of your screen. So as we're going through the presentation, then please do type in any questions that arise, and I will pose those to Chris at the end of his presentation. Before we do that, I'm going to try something that we haven't tried before. We're going to run a quick poll. Just keen to see if the view of you as attendees, as a great sample group of business leaders, business owners and entrepreneurs, feel positive, neutral or negative about the budget. I'm going to do this, Chris, before your presentation. Perhaps I should have done it after. But I'd just like to gauge sort of a gut feel from you all. So if the technology works, I'm going to try and run this poll now. Please do respond. Hopefully you can all see that. Perfect. A few more votes to come in. Brilliant. And then polling in 5, 4, 3, 2, 1. Let's share the results. So hopefully everybody can see those on the screen. Is that right?
Yep.
So 58% of you feel positive, 38% neutral, and just 4% negative. So interesting results, Chris, and interesting to get that feedback. And I think, as I said, probably as we thought, what we all expected came out earlier in the week, and that's what we see in these results. But I'll stop sharing those now, and I'll hand over to you, Chris, and I'll be back at the end of your presentation.
Thank you, Ryan. Right, so I've entitled this support, payback and work on the future, primarily just because they were the words that Rishi used when he stood up on Wednesday to go through everything. Ahead of time, this was supposed to be about levelling with the electorate on what the real state of the economy was. So I thought I'd just run through the big picture, what measures have been put in place in terms of extra COVID support, tax changes. He also then moved on to talk about investing in the future with a green agenda. and also what's to come. What didn't he talk about, and what are the key areas that perhaps might be on his shopping list as things go forward. I've just gone with a little picture of a tap here because this was perhaps one of the most leaked budgets that I think we've had for a very long time. So much so that we had prepared some pre-budget material on Monday, and by Tuesday we couldn't use any of the PR pieces that we'd put together because they'd already been put out there in the press. So a lot of the larger measures had been talked about in the press, but also it did leave him a few little bits to just put out there on Wednesday. So if I just run through sort of the big picture of what the economy is looking like at the moment, and there are some staggering numbers that it's taken me a while to get my head around, really. That total COVID support thus far, or will at the end, have cost 407 billion, sticking to his whatever it takes mantra. Now, 407 billion takes the country, and this is the staggering bit, to a net debt position of £2 trillion. So actually, COVID support has cost something like 25% of our initial previous debt position. So the impact of it has been absolutely astronomical. He was quoting that that's then given us a 10% reduction in the size of the economy, which is the biggest reduction that there's been for 300 years, which has been propped up by our largest borrowing outside of wartime, so in peacetime. He then talked about the GDP figures. So the highest point will be 97.1% of GDP in 23-24. Now, I thought about that and I thought, well, how many of us would run a company with debt levels at 100% of our turnover? And I'm not sure there are too many of us that could continue to do that for very long. So I think that is a huge number, but also to put it in context, that's not a problem that is just related to the UK. So I did some research on other countries around the world. So the Eurozone generally, and these are numbers from November 2020, so they will have got worse obviously since then, were 85% of GDP for average Eurozone country. Italy at that point was 130%, France was 100%, and the Germans were way down, I should expect, at 60%. But I think that just gives it context that this is a huge problem, but it's not just a problem for us. It's a problem for every country, and I think it will take someone far more educated on world economics than I to tell you quite how that will all unfold. But it's big numbers and it's a scary number, but actually in context, we're kind of in the same place as a lot of people. And he did put out the calculation that every 1% of interest rise will cost 25 billion pounds in debt cost now and serviceability. Now, I can remember when interest rates were 5%. That wasn't that long ago. And then I think if you start to think, okay, if we get to that point, and it's going to take a heck of a long time to pay down all this debt, interest costs themselves could spiral very quickly and very easily. So I think the kind of timing of everything with the availability of fairly cheap debt at the moment has kind of helped everybody out, really. But I think that's just something to think about, in that those are huge interest numbers, and it kind of starts to build the picture that actually this needs addressing sooner rather than later. It's just a question of how soon can the country sustain it and how soon can business sustain it. So points to be considered for the future, I think. He also talked about the growth figure. So was expecting 4% growth this year, 7.3% 2022, and then dropping back to kind of normal numbers at 1.7% in the years after that. Now, Rishi was suggesting that actually by summer 2022, he thinks the economy will be kind of free of COVID issues, shall we say, and actually be running normally, just with the debt burden that we've got, which those kind of growth figures tend to support. But in the Office of Budget Responsibility had predicted that if we hadn't had coronavirus, in 5 years' time will be around 3% smaller than we would have been. So not a huge difference, but still fairly noticeable once you get to 5 years' time, plus that debt burden. Now, he also talked about employment. So 700,000 jobs have been lost since that start. Well, probably pretty much almost to the day this time last year. That could have been a lot higher is the discussion if it were not for the furlough scheme, and we'll come on to that in a little bit more detail shortly. But the unemployment rate of 6.5%, it sounds like it's creeping back up to a high number, so I thought again I'd give that some context. In the late 2000s that was 8.5%, and the prediction pre-furlough scheme was 11.9%. So obviously if you are in that, or people in that 6.5%, it's a horrible place to be, but in terms of the economy as a whole, we have seen worse in recent times, and thankfully come through that and reduced the rates thereafter. The little table at the bottom of this slide actually indicates the costs or income that he thinks will be generated as a result of this budget. So it takes 3 years from this budget to actually, the measures involved start to produce money back for the government and turn them into a profit. But even by 2025-26, that's still only 29 billion. So when you consider that COVID measures alone have cost us 407 billion, this is going to be a long road back. And one of the things the Chancellor did say was this is going to be a problem for many years and for many governments. So I think how many governments will be determined by the political will of people to, or of the party in power to actually risk some votes and probably raise some taxes to actually get the debt paid back. So we'll see just quite how long, but that table I think starts to indicate how long the road is and how far back things are going to have to come. So the COVID support measures that were announced, and I'll look at them more in a bit of detail in a moment individually. So we had the furlough scheme extension to September, which I think, as Warren mentioned at the start, surprised a lot of people as to how long it would be, with kind of unfettered results, really. There was no narrowing down to potentially hospitality industry or those in the travel industry or airlines or anything like that. It was, okay, furlough will go until September for everybody. Some more support for self-employed people, adjustments to business rates again. And you can even, there's a new loan scheme out, so you can even take on more debt in your business if you'd like. And then I'll just cover some general sector awards that have come up as well. So the first one to look at is the furlough scheme. So furlough will run now until September. Presumably, when I first heard September, I was a little bit worried then about what happened to the roadmap of everyone being open in June. But I think this is him being extra cautious and not needing to revisit it again, with the hope that by June, a lot of people may have left the furlough scheme. It is worth noting that as of January, there were 4 million people still on the furlough scheme, which is a staggering number, I think. And actually, the worrying factor is how many of those jobs are real, and how many will people actually be able to come back to. I think the hospitality industry accounts for something like 1.8 million of those jobs. So it is still a large proportion that don't relate to hospitality, and actually what do they relate to, and are they real live jobs? So watch this space on those. But the broad headlines on the furlough extension is 80% continues to get paid until June, and then in July, August and September we see the payback that was scheduled to happen, or did happen last year, where employers have to contribute the extra 10 or 20% to top up the 80% that the employee receives. So no kind of real changes to the scope of how that is, or the kind of workings of that, but it's more just changes to the timescales and the employer contributions. Self-employed individuals, so there will be a further round of income support that self-employed people have been claiming as part of the scheme. Again, the fourth round will be 80% of average profits. There is now then a fifth round opening, and that will now be open for 1920 tax returns. So originally when the scheme opened, people who hadn't been self-employed for more than a certain period of time, I think it was, well, it's certainly done an 1819 tax return. So the newly self-employed were missing out on the scheme and any support. And they've now come in to this in the fifth round. So at least there is some support that is being offered to those who previously missed it. The good old question of what happens to company directors is still out there and has been ignored again. But that's probably not a surprise, and I don't think we were expecting anything different from that. The only thing to note is if you are looking at claiming the self-employed support, it is more dependent on your profits this time, which is probably fair in that self-employment differs from furlough in that there's no requirement for a self-employed individual not to be working. Whereas the fifth round of funding that's going to self-employed individuals does depend on how badly the business has been affected and therefore what their profit level has been as to how much they can claim. So a little bit more means testing, I think, dropping into that system. On the business rates front, breaks for retail, hospitality and leisure, and the 100% rates relief that they've enjoyed for the last, well, I say enjoyed, received for the last year or so will continue for the first 3 months of the year. Depending then if you can stay open or, stay closed or you can reopen, there will be further reductions for the rest of the year. So 2/3 is the maximum that will happen for the rest of the year. And upon reopening, depending on if you can reopen in kind of the April phase of the plan, or if you have to wait until June, there will be grants between £6,000 and £18,000 available per premises to look at when or ready for assisting you to reopen. Again, there'll be local authority administered as the rates relief has been so far, and you will need to, I would advise that you're proactive and make a claim. I have heard of clients where the council have actually come to them, but I think that's probably an exception rather than the rule. So if you've had the reductions already, start looking at what you can do for this year, and also have a think about the restart grants. Talk to the local authority and see where you can start to claim those. And this was the more debt option. There is a new recovery loan scheme coming out, which I'm sure if you know anyone that works in the bank, they'll be overjoyed to hear about. This can take the form of either a fixed term loan or asset finance, invoice financing. And you can take this additional borrowing if you have already had a coronavirus business interruption loan or a bounce back loan. So this can be additional top-ups and will be between 6 and 3 years. This moves more back to a traditional loan format in that there's no interest-free periods. You do need to convince the bank that you are kind of good for the money. It will be a more structured approach, I suppose, rather than the people who claimed bounce back loans will remember you kind of had to fill in about a 1-page form and someone sent you £50,000. This will be more compliance-led and similar to the business interruption loan process. Again, the government's guaranteeing 80% of the debt, so no personal guarantees for up to 250k of borrowing, and they shouldn't be asking for your primary home as security. So again, it's good support. It's a question of whether the appetite is there for businesses to take on more debt, and I'm sure Warren will have views on that as well afterwards. But it's perhaps worth looking at if you really do need to do that. That is launching 6th of April, so applications aren't open yet. And I would imagine, given the requirements from a bank point of view, there might be a little bit of lead time before or that 6th of April date gives them a little bit of lead time to get things organised, ready to go for applications. So there is a website on the British Business Bank, or there is a page on the British Business Bank website which talks about it. So it might be worth just having a look if that's something that you're interested in or want to think about. General sector awards, won't really talk too much on these, and I think again a lot of this was talked about in the press. I think the biggest one is the VAT on the hospitality and tourism. The 5% reduction until 30th of September stands. It's what they had when they were able to open last summer. There was no return of the Help Out, Eat Out scheme, which had been bandied around in the press, or certainly not yet. And then the VAT will drop after 30th of September to 12.5% for the remainder of the tax year, so up till the end of March again. So again, a little bit of a break for hospitality and tourism sectors. It then depends on, I think, how the economy is looking, whether he will do anything further with VAT. And I'll come to VAT as a general sort of option in a bit more detail later on. And this is where things started to get a little bit, what's the word, tactical, I would say. So in his manifesto, which he's trying to stick to, he is bound by saying that there can be no income tax, NIC or VAT rises during this parliament. Now, on one hand, you might think, well, you know, fair enough, we've had a major upheaval since then, perhaps we don't need to quite stick to that. And on the other hand, you think, well, he's trying to stick to that, okay, good luck to him. Now, one of the things that has been changed is previously going on for the last, well, infinitum really, the personal allowance before you pay any tax has been raised in line with inflation or higher, and also the higher rate tax band as well. Those bands will now be frozen until 2026. So inflation rises will not apply, and they'll be capped at the limits on the screen at £12,570 before you pay any personal tax, and £50,270 before you hit 40% or higher rate tax. Now, one can argue that that is an income tax rise if you're not raising those in line with inflation, but I suppose on a technicality it's not, you're just holding an allowance. Those measures alone will be worth £2 billion per year, compounded for the next 5 years. So 2 billion in year one, 4 billion year two, 6 billion in year three, etc. So just by that very simple measure, it's quite a large and quick change. And I think it moves somewhere like 1 million people per year up a tax bracket. So those changes are huge in terms of what they actually produce. And not too much was made of this at the time. But actually now people are starting to calculate what it means and actually understand what it means. He's starting, and I saw this morning, I think he was quoted by the Institute of Fiscal Studies as being a bit of a Scrooge in doing something like that. So a technicality or a smart piece of thinking, I'll leave you to decide. And we had no change of entrepreneurs relief or business asset disposal relief, as it's been known, or as people commonly know it, 10% tax when you sell the business. That was something that's been talked about a lot, and it was seen, there has been a revenue consultation on the effectiveness of that relief and also of capital gains tax in itself. So for now, no changes. I think on that, on all of this really, the important thing to note is the budget was supposed to be an autumn event, and it is only, or the government have switched it to being an autumn event, and it is only due to Corona that we have gone back to March. So my gut feel is that it won't be far before we hear news that there will be another budget in the autumn, when measures and hopefully everything has been relaxed and we're starting to be a bit more back to normal, and that actually we'll have another budget in the autumn. So I think that's just something to keep an eye on, the progress of those capital gains tax changes and consultations. And companies, this is where it starts to get headline grabbing. So from April 2023, standard rate of corporation tax changes from 19% to 25% for all profits above £250,000. Now, if you go back, I will say 5 or 6 years, may even be more, then the top rate of corporation tax only kicked in if you had profits more than 1.5 million. So whilst that was 28% at the time, the reduction in that top rate has come down quite quickly. The one side of this argument is it still keeps us very competitive within Europe, within the G7 situation. The flip side is, and we know this, we've seen it in practice, people are more prepared to pay tax when it's at a lower rate than when things get higher. So we'll see what that actually does to the tax take, but it's predicted to increase it per the Treasury guidelines at the moment. And I'll come to some examples of what that actually means for business in a moment. If you've got profits up to 50k, you'll still be paying 19%, and then between 50 and 250, there'll be a graduated tapering to take you up to the 25%. I would do you a calculation just to show you what happens to someone at 100, 150, but there is no policy out there yet to show us what those calculations are. I've put on here watch groups of companies. Now, what previously happened when we had graduated tax was to stop you having a company that makes 300,000 profits and splitting that between, say, 2 separate businesses. The revenue start to divide the limit per the number of businesses and companies that you own. Now, I would fully expect that to come back into play because otherwise it's just an easy way of someone earning £400,000 of profit just splitting their company in 2 and staying under the 250 limit. So I think when you have more than one company that you own and control, you just need to watch who's paying tax and at what rate, and it then starts to bring back into play those kind of issues, which have kind of gone away for the last sort of 5 or 6 years, in that the tax rate has been 19% flat, irrespective of where you've been making money. So it will suddenly become a lot more relevant as to which of your businesses are making money and which are losing money when you look at the tax rates that they're going to be paying. The other situation is, if you are a large company at the moment for corporation tax purposes, you do have to pay your tax every quarter. And my sort of prediction for the medium term perhaps is that this is a step towards having all companies pay their tax every quarter, potentially. You know, a lot more people have real-time information of how their business is doing with their sort of online accounting packages and things now. So I feel that a lot more companies may change the definition of what a large business is, perhaps if you're paying full rate corporation tax, and start to be paying quarterly as the year goes along. So that's something to just keep an eye on and see what happens as a bit of a prediction, I think, in a year or two's time. There is a concession now that you can, if you have made a loss in an accounting period that ends after the 1st of April 2020. So if you've had a year end, or you're about to have a year end after April 2020, you can take that loss back 3 years now. Previously it was only 12 months, but for concessions due to a lot of companies, I think, will obviously be making or having a lot worse a year during the 2020 period. They are allowing a 3-year carryback instead of the 1 year, and that carryback is capped at 2 million. So something to look at. That carryback option also applies for self-employed individuals and partnerships. So if you are one of those people, then you could look at carrying that loss back as well. We are at the moment going through all of our client base to see whose accounts we have done since the 1st of April 2020, or who've had a year end since the 1st of April 2020, to check whether there are now additional claims that we can make on their behalf. So I think that's something to be aware of, depending when your year end is. And also, if you are loss making this year and you do want to look at cash flow, you might want to consider a slightly earlier year end, just to advance that potential loss claim that you could get back money from HMRC. I think the question with the corporation tax change is going to be, am I still in the right place to be a company? is dividend still the right route to take my money out of the company? So I have had a look at what would happen if you had two director shareholders, say taking 100,000 each with a 250k pre-tax profit. So I've tried to run the numbers on where we'd be now, so at 19%. What would happen with a 25% tax rate? What would happen if they weren't in a company anymore and they were just trading as a partnership? And what would happen if they were still in the company but took all their money out as a salary? Which, you know, has long been the kind of least tax efficient way of doing things, but still wanted to check that was how it was with these changes. And as you can see, the 19% after you deduct the dividend, after you deduct the corporation tax, each person gets roughly 100k, which they're taxed on, and they end up with 81,000. If that moves to 25%, that dividend becomes 93,750, and shade under 77k lands in their pocket. As a partnership, it's not much different, where they pay the personal tax and national insurance from partnership profits. But as a salary, you are still the least tax efficient, after we take out an allowance for employers' national insurance as well. So you are still in the right place if you've got a company and you're taking dividends, but the gap has just got a lot narrower again. And it's that continual, I suppose, narrowing of the gap and convergence that the revenue keep chipping away at, as we saw a few years ago with the dividend tax rate increases. Now, what I would say about the 25% band is that there have been a couple of articles that I've read in the last few days which are questioning if that will actually take place, or if, as we approach a possible general election in 23 or 24, that measure might get dropped. So it's something to be aware of. And one of, I think, again, the Institute of Fiscal Studies was saying they see it as 50-50 whether that measure will come in. I saw an article by Laura Kuensberg this morning where she'd asked the government minister if they could confirm that that measure would actually come in April 23. And again, they said no comment. So whether it's posturing, whether it's just looking like they're doing something and actually in April 23 it will stop, I don't know, but we can only work with what we know. So something that we need to be mindful of in planning for April 23. And this was kind of greeted with big fanfare. And I'd love to know who comes up with the names of these different reliefs that you can now get for taxes. The super deduction. So this is designed to encourage people to invest in their businesses and claim additional tax relief for capital expenditure. So if you want to go out and buy some new, currently if you go out and buy some new machinery, you spend £100, that £100 comes off your taxable profits and saves you tax at 19%. Using the super deduction, that £100 becomes £130, and you would save £24.70 of tax. So an extra £5.70 for every £100 that you spend under this measure. It was touted as being a lot more fruitful than that, but I think that is, you've already got 100% deduction for the first £1 million you spend on equipment. So you're only really getting an extra 30% extra. If you are a capital intensive business and you're spending more than £1 million, then it starts to have value because it has no cap on it. Whereas the annual investment allowance of the first £1 million does have obviously that £1 million cap. So unless you're quite a large business with a heavy capital expenditure, I'm not sure too many people are going to make capital expenditure choices on a kind of a minimal saving on what they're already spending. Now the key point on that is only in place for 2 years, and it's things bought after the 1st of April 21 to the 31st of March 23. So I think what that is designed to do is to encourage people to spend and upgrade their equipment and capital expenditure before the proposed tax rate increases come in 2023. Because I could see a situation where a lot of companies would store up the requirement to spend until 23, knowing that they get a better reduction against a 25% corporation tax bill rather than a 19% corporation tax bill. But actually, this scheme won't be in place in 23. So it's kind of, I think, a part measure to encourage that investment, and part so that people don't defer capital expenditure until they think they'll get a better rate of tax relief. So a little bit cynical on that one, and not quite as good as I think first. So I'll call that the not so super deduction. Other tax changes, stamp duty holiday to 30th September. Again, it was something that was talked about in the press. There was a lot of chat that actually that would remove the cliff edge that is the 31st of March, or was the 31st of March currently. But I'm not sure if that just surely means that we'll have another cliff edge at 30th September where everyone is trying to get their property deals done by 30th September. So we shall see quite how that one pans out and when that support ceases to be, but I'll be surprised if it goes past 30th of September. There will also be a review of the R&D tax credit system, just to check that the ways in which people are claiming the amounts that are claimed are actually working as they're intended. There are already proposed adjustments on the way in terms of the amounts you can claim back against your payroll or payroll taxes liabilities. So it's one to keep an eye on, and one that's, you know, the revenue giving money out. So they are going to be looking at that closely. And also one that I think will affect clients is a review of EMI schemes, just to have a look at the terms and conditions to see if they're still competitive. People's working ways have changed a lot since those schemes came in 2000. I think they're in 2003. So I think an update of those rules would be good, but it is just to see. I think the changes should be positive, and look at the ways people work and who they work for and those kind of regulations. So things to keep an eye on. And he then moved on to what we can do kind of moving forwards. So away from tax, the Help to Grow scheme. So I've put the link on here, and I know the notes will come out after the presentation, but essentially the government are 90% funding training for managers within the business, or decision makers. So for SMEs, as I've put on here, 5 to 249 employees, if you've got that kind of next expert, or maybe even yourself needing that bit of management training, they're offering to help support that with 90% funding, and that is open now. So given something like this, I would say register interest early rather than trying to wait until it might actually start. There's also Help to Grow Digital, which will come with discounts on software, and with a slant towards helping grow digital businesses. So I think a really good incentive, and a really good looking scheme. I've had a look around the website, and I know it's something that actually we're going to look at here internally. So I think it's something to have a look at, just see if it applies to your business, and actually if you think the kind of topics that they want to cover are worthwhile. Also, they did announce, or Rishi did announce, that on Wednesday the apprentice incentive will now be increased to £3,000 per person, rather than the £1,500 it was previously, and that covers anyone of any age, whereas I think before some restrictions have been around how old the apprentice needs to be. So again, have a look at that apprenticeship, and depending on how big you are, you perhaps pay apprenticeship levy anyway. So maybe worth having a look at that to try and use some of the money that you've put forward. Also mentioned some green initiatives. There was a big thing made about in the speech about how it would be setting the UK up for a green future, but I did do a control F on the budget speech, and I think actual measures came up with about 6, so not a huge number given the lead up it was kind of given in the speech. There will be a new UK infrastructure bank, which is supposed to be dealing with primarily green initiatives, projects, public-private partnerships, and that will be based in Leeds. again, part of the national levelling up around the country that is talked about often in the kind of north-south divide, etc. And that's going to be started with 12 billion of funds and potentially leading to around 40 billion of infrastructure changes. So if that works, great. You know, all in favour of that. There will also be a green savings bond with NSI, and the government are offering a green gilt raise to try and raise 15 billion with money spent on green projects. So it'd be interesting to see the kind of reception that gets on the gilt market. And there was also announcements of smaller local projects around the country. I think there were a few in Wales around hydrogen technology, some wind farms. So kind of, yes, there were some green things in there, but perhaps not quite as many as maybe was originally thought. Other things that came up. So they were announced free ports, and I've only put this in here because one of them, which was successful, was the Solent. I think BCP did also apply, but wasn't selected. But the thing about these is that if you start your business in those free port areas, or you buy business property in those free port areas, you can take advantage of tax reliefs for doing those. So I also had to look up the concept of a free port. So goods can come in and out of the UK without having to deal with a lot of the hassle and paperwork, etc. But just the employment and the infrastructure that those ports create could be an opportunity for some people to get involved in what's happening there. And also on a local level, Boscombe was awarded the £22 million for the regeneration around the I think the High Street area and the Sovereign Centre. So yeah, good to see that money coming into that area. There'll be a new migrant worker system. He was at pains to say that it will be for qualified, skilled people coming into the country, probably playing a little bit to the voters. So we'll see quite how that pans out. But also, I think the bigger issue on that is how quickly that can come into play. There'll be money made available to local communities to buy sports clubs or pubs in their local area. Again, something that got leaked out prior to the budget itself. And all planned changes to alcohol and fuel duty were cancelled as well. So I did start to have a think at what comes next, and I thought this was quite, I was going to say interesting, but that probably says more about me than anything else. Interesting graph as to where actually tax raises come from, and the three kind of biggest chunks on this pie being income tax, national insurance, and VAT. And those are the three things that he said he will not raise, or the manifesto said they would not raise. So if you've taken those three things out of the equation, it's quite hard to raise significant sums from any of the other areas when you have a think about how big the debt burden is generally. So I think at some point those kind of golden areas will need to get touched, and whether something like a small 1% increase on income tax or something like that happens is my kind of personal view, I suppose. But if you take out over half of your tax raising potential, that makes it very difficult to claw back such a sizable difference. So something to keep an eye on, but actually I think it gives some context as to the predicament that he's faced with, really. And I've gone for a kind of what's next and I think the chap getting his water torture is probably the most accurate analogy I could think of, in that I feel like there'll potentially be one or two announcements per year that help kind of build up and claw this back. So I had to think about what are the other areas that we didn't hear anything about that could come in the future. So capital gains tax, we've already sort of said there's been a consultation. The current rate for non-residential property, I suppose, well, current rate of capital gains tax could be is anywhere between 10 and 20 or 28%. I don't think it's a huge stretch to see them putting 5% on each of those rates, for example. But again, nothing announced at the moment, pure speculation, but you could see that option is there, and it wouldn't cost too many votes. Changes to inheritance tax, and here I've put, it's not a very Tory policy to start increasing inheritance tax, so perhaps not. And the other one that's been ignored or kind of sailed under the radar at the moment is an online sales tax. There's a lot of chat about saving the high street, how the online retailers have got the unfair advantage, but actually we heard nothing about it. So whether that's kind of in the too hard basket at the moment, I don't know. But it does feel like there is potential for something to happen there. And also on the back of the Uber court case the other day, the gig economy. So currently, people, or previously, I suppose, people who work for people like Uber, Just Eat, Deliveroo, etc., are all technically, or were technically, classed as self-employed people. Now, the court have ruled that they should be seen as workers. I'm aware that there's kind of a definition difference between workers and employees, but I don't think it will be too long before HMRC start to pick up on, okay, so if they're working for those people technically, why are they not employed? Why have we not got national insurance from an employer point of view? So I was surprised. I think it might have just been too soon for that, but I think there might be a few more reforms coming potentially on that front. So overall, those were the key pertinent points, I think.
Perfect. Thank you, Chris. Thanks for a great summary there. Some really interesting points made, and I like the thoughts around what may come next. It's interesting to see. I think I concur with your view. Other taxes are going to have to increase. He's going to have to find other ways of generating revenue if he's going to keep to that manifesto promise. And I also think the drip feeding of tax increases and tax changes will happen, so it doesn't feel like we're under the cosh in one go. So it'll be interesting, as you say, also to see what happens in October, particularly around capital gains tax and entrepreneurs relief. But some interesting other measures you've announced or highlighted there, that help to grow.campaign.gov.uk website to register your interest. Both those grants for training for our management teams, but also the Go Digital. And it's got quite a wide scope, that Go Digital, when you look at it, hasn't it, Chris?
Yeah, yes. I was quite surprised with both of those measures, actually. It felt like, and I don't know if this is part of, I think Rishi has quite a business background, and actually whether he's kind of tuned in a bit more rather than it being a kind of a tax kind of boring measure, if you like. It felt like an actual help to business.
Yeah, no, definitely. So definitely worth going to that website and registering your interest, because if it's anything like schemes like that before, it is a kind of cascading kind of, you need to register your interest early to get and grab an opportunity of some of that funding. And obviously, we've got some questions that have come through. Some around the new recovery loan scheme, which was interesting to see announced. I think you made the comment, the local bank relationship managers and directors will love that. Another thing for them to deal with. But I actually think that is a really good measure, because when you talk to the relationship managers and directors at the banks, the main clearing banks, they're all worried about, off the record, what the bank's view is to be able to support and provide further debt and lending post the COVID if CBILS wasn't there. And at least this gives this guaranteed scheme that enables them to continue to support businesses. So we've got some of those questions on that recovery loan scheme, and one of those is what's the difference in interest rates between the old and new scheme? Is it beneficial to get a CBILS scheme instead of a new recovery loan? I can answer that. I think the answer is go for the CBILS loan, but you've only got to the 31st of March to go get it and put your application in. That is because the new recovery loan doesn't carry the same benefit of being a year of interest and charges free. So you lose that benefit. And I think the banks will probably start taking a different view with regards regard to those personal guarantees as well, whereas they've all stated, although they could be taking personal guarantees on a loan above 250,000, none of the main banks are, and I don't actually know even any of the second tier that are taking the guarantees. So the CBIL would be the preference there. And a question that also follows on from that around cash balances in the business. And does that stop you applying for either the CBILS or the recovery loan? My answer is no, it shouldn't. And if the bank are saying that to you, then you need to push back, because actually under the CBILS loan, what you've got to do is you've got to prove that your business could need this funding as a result of CBILS. And with the recovery loan, it's for a legitimate business purpose to aid and fuel future growth and cash flow, again, as a result of CBILS. So I think if you can put the forecast together and the case forward, it doesn't matter that you might be sat on cash right now. I mean, if you're sat on cash right now and profitable and can't show a need, then the bank's going to resist that rightfully, because that's not what the schemes are for. But if you're sat on cash and there's a threat of cash burn and you've got a legitimate purpose, wholeheartedly, Chris, you, me, and Andrew and others in Inspire have helped our clients obtain CBIL loans for that exact purpose, haven't we?
Yes, yeah, sure. And it is more about what you present to the bank in terms of why you need the money, rather than kind of how much you have or haven't got right now. Actually, why do you need more, and what are you planning to do with it, and how have you been affected by what's happened is more of the measure, rather than kind of rather than your balance sheet looking kind of too good, I suppose.
Yeah, definitely. And then a question on the super deduction, or you perhaps aptly put it, the not very super deduction. A question here is, can I use this to refurb and undertake building improvements on a property that we lease?
Oh, how? Right, so if normally if you go for a lease, the terms of who owns the assets that you maybe improve within the building, and also the allocation of capital allowances on those assets will be dealt with in the lease. So I know that's a wishy-washy kind of answer, but actually it does come down to what's in the lease and what you're buying. So yeah, happy to sort of have a look at that and chat through sort of the particular exact assets, really.
Yeah, I've made a note of who's made the question, and we'll follow up directly on that. That's probably the best way, because like I say, it's quite a technical area. I mean, generally that super deduction is there for plant and machinery purchases, isn't it?
Yeah, there is, if you do buy anything which is known as, in tax terms, integral features, so something which sits within your building, like a hot water system or something, that super deduction, instead of being 130%, well, you still get your 100% annual investment allowance, but if you breach that million, that deduction comes to 50% instead of the 130, but that's still 50% instead of 8%, which it would be without it.
Yeah, perfect. And then our final question at the moment, so if you've got any more questions, do please post them, but our final question at the moment, can I use the new recovery loan to refinance an existing CBILS loan? I think that's not going to be a qualifying purpose. I have loaded up the website just to see on the British Business Bank, and it does talk for legitimate business purpose, including managing cash flow, investment and growth. So I think refinancing existing debt will be a bit like the existing CBILS loan. You couldn't take a CBILS loan out to refinance existing debt. And my belief is this will be the same, because most of the rules that they're outlining seem to reflect the CBILS rule, except that 12 months interest free, which is
and also with the CBILS, they offer a little bit more flexibility in terms of there is a payment holiday option in there, whereas on the recovery loans, from what I've read thus far, they seem to be much more strict as to kind of, they're a term loan, you repay the loan, it's like a normal loan.
Yeah, there is no there's no allowance for that. But although they are saying they're up to 6 years, so there's an extra year. They're not a 5-year loan, they're a 6-year loan, so that will help cash flow a little bit. But yeah, watch this space as further news comes out. But I think if you've got an application going in, talk to your bank about it coming under the CBILS regime is definitely the way to go, because that's a known scheme with lots of good benefit. So I think that's the end of the questions, Chris. Thank you. I know you've been working hard to put the presentation together, reading all the budget notes. As ever, it's the devil's in the detail, and you've done a great job today. Thank you, of summarising some of the measures and also giving some thought-provoking kind of points and pointers as to what may come next. Goes without saying, everybody on the call, it's great to have your support. Thank you for joining us today. If there's anything that you've heard today that you want to question or query, then please do pick up the phone. If you think there's something you can benefit from or something that's going to affect your business, we're here as ever at Inspire to support you. So thank you for joining us. As I say, hope you've enjoyed that, and hope to see you and catch up with you all soon. Stay safe.
Thanks.